All right, guys, welcome back. It looks like silver has broken near-term support right now, and it's kind of flirting with whether or not it's going to continue going down or not. Remember, we've been taking a look at some of these moving averages, the 20 and 60. The 20 went below the 60, basically 1 month versus a quarter, and it's heading down. And some people are positing that, hey, it could be because of some of these things that Jerome Powell is saying, in addition to the overall movement of the U.S. 10-year Treasury. Now, take a look at what he had to say here from this article on Kitco entitled Gold Price Fails Attack on 1750 as Fed's Powell Hints Tapering. So let's go down. And this is the section here that I'm going to read. As we make substantial further progress towards our goals, we'll gradually roll back the amount of treasuries and mortgage-backed securities we've bought, Powell told NPR's Morning Edition in a live interview. We will very gradually, sorry, I have this thing that's kind of in my way that you can't see. We will very gradually over time and with great transparency when the economy has all but fully recovered, we will be pulling back the support that we provided during emergency times. The Fed currently makes $120 billion in monthly bond purchases. Now, obviously, to explain the relationship between the Fed and these bond purchases, they're one of the largest purchasers of bonds. Now, obviously, there are also foreign entities. There are some other domestic institutions that buy a lot of treasury bonds, but the Fed is one of them. And, quick note, when you buy treasury bonds en masse, or when people buy treasury bonds en masse, the yield goes down when the demand isn't there for treasury bonds, or there's a lot of selling, then the yield goes up. And we're starting to see the yield go up when it comes to treasury bonds. And one of the other things that people say is, hey, this is more of a risk on appetite here. But the thing about it is when treasury bonds go up, they're going to start creeping out of their negative yield range, which is beneficial for gold and silver prices. Now, they're still in the negatives, but until inflation, or I should say the CPI, catches up, that could be something we contend with. And with Powell saying that, hey, we're going to make less of these purchases, that could be some potential down pressure on metals. Now, when will this actually happen? Well, they said that, hey, when the economy really starts to open up, and things look good, then we'll start to make less of these bond purchases. But how can we really forecast when this will happen? Well, guys, I actually dug into some data, and I know that some of you guys really liked my old videos when I used a lot of spreadsheets. So I have a spreadsheet here for you that I'll show soon, but I want to first preface it by showing you this. So obviously, one of the main things that people have been noting is that with the economy, there is a relationship between when the economy reopens and these shots, let's just say, so YouTube doesn't throttle this video. Now, I know some of you guys feel different ways about it. I'm not pointing you either here nor there. I'm just pointing you to the numbers and to the data. So you can look at the numbers and the data and have any kind of feeling you want about the shots. But, hey, as I always say, a bad guy or a good guy could either say 2 + 2 = 4. At the end of the day, 2 + 2 = 4. So here we have different countries who have either got 1 shot or 2 shots, let's just say. And Israel has, basically 50% of their population has gotten both. Now, the US or the United Kingdom, they've done pretty well with their first one, but the second one, not so much. The United States, actually, over 50% of their first shots, over 50% of the first shots, basically we have second shots over 50% of the first shots. So I'm going to look at the United States because, as they say, when the United States sneezes, the world catches a cold. So this is what I did. Now you're going to see a spreadsheet here entitled Vax versus Economy. Now, I just want to have a little fun with this. But basically what you're seeing here are the following. You have the dates. Now, these are weekly dates. These dates are dependent upon jobless claims. So I'm looking at the doses and I'm looking at jobless claims and the trends. Now, my hypothesis was the more of these shots that go out, the fewer the jobless claims. Now, obviously, a lot goes into jobless claims. It's multivariate. You can't just say, this is the end all be all. This is the only sole reason why jobless claims are going down. So that's an error in this, I guess you could say, in this experiment. And generally can say there are many other errors that you can find. But I just wanted to show a quick and dirty look at the relationship between these shots and jobless claims. So just getting that out of the way, yes, I know there are other things that will impact jobless claims. Okay, so these dates are based upon the weekly jobless claims dates that get put out. So we just had one come out today that showed the jobless claims ending on March 20th. So I went all the way back to the 17th of January. And as you can see here, doses increased for the first dose, and the second doses increased as well. And again, this is for the United States. Now I'm going to bring you all the way over here to above the graph. So now I wanted to look at the correlation between the first dose and jobless claims. So we had a correlation of negative 0.821. And for fully, shot up versus jobless claims, we have a negative correlation of 0.8222. Now, so it's a little bit stronger, a tiny bit stronger for the second shots versus the first shots, which kind of makes sense. And the interesting thing here is that with negative correlation, that basically tells you that the more of these things put out, or the more that the numbers increase for the shots, the lesser amount of jobless claims that there are coming out. So the relationship is strong, and it's a negative relationship. So taking a look at the, Creative Cloud quit. Let me just get that out the way. So taking a look here at the relationship between jobless claims and the strongest relationship that it has between the two, which is the second shots, we see a slope here. And this is essentially the regression coefficient. And without getting too technical, this is a slope. And the slope was the greatest in the beginning, and then it slowly comes down. Now, as you can see here, we have a graph of this over time. The jobless versus the shots over time. Now, I'm going to scroll down here so you guys can get a better view of this. Let me move this over. And now you can kind of see it a little bit better on the screen. And as you can see, from January 17th going to March 20th, we're seeing this relationship come down. Now, what that basically shows you is that in the beginning, the relationship was much more extreme. So the more of the second doses that were out there, the more that these claims came down. And over time, the more of the second doses that came out, the the jobless claims still came down, but not as aggressively. So we're starting to see the line begin to, it still is coming down, but at the end of the day, it is slowing down. So it's interesting to see that the jobless claims are, somewhat slowing down relative to the second shots coming out. But it's also really interesting to see the correlation be so strong. So again, correlation does not mean causation. And jobless claims, there's a lot that goes into it. That's not just about these shots. A lot of it, there's a lot of stuff that goes into it. Multivariate, as I mentioned. But I wanted to point to this and make this graph and do this experiment because I wanted to see, again, when would the Fed be looking into doing less asset purchases? And is there something that we can take a look at to maybe anticipate this? Now, this is the quick and dirty way that I want to use to anticipate this. And as we get more data from other economic data that impacts GDP, such as consumer sentiment, such as ISM, and various other data, I'm going to also be comparing it to the shots. But unfortunately, that data only comes out either monthly. Sometimes that data comes out quarterly. So the amount of data that I have won't really be that vast as much as weekly data that jobless claims gives me. So that's why I use jobless claims. So guys, let me know what you think about all of this. It looks like as far as jobless claims are concerned, and again, the Fed is very concerned about jobs, they could be perhaps looking at these shots. Maybe they're looking at this video and saying, maybe we should consider this. All right, guys, let me know what you think about this in the comment section below. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion for goldandsilvertoday.com.